This
Good
meeting
morning.
is being recorded.
Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with Taylor from Life Goal Investments. How you doing, buddy?
You're the man, Michael. Thanks for having me.
Absolutely.
I'm doing great. Thanks.
Thank you for being my newest edition of this. You are filling an important void. Nobody of my experts really is a Wall Street guy or Wall Street person. So thank you for doing this every Monday with us. I appreciate it. One thing I have to ask, why'd you exit Wall Street, man? All the money there. Why'd you go create your own thing? I mean, taking all this risks. Why'd you do it?
Yeah. It's a great question. And it really goes back to growing up. So myself and my brother's actually my co-founder of the company too, who spent 15 years on Wall Street.
Oh, that's cool.
We grew up in literally, Michael, a one red light town. And I don't say that as an exaggeration. A one red light town in the mountains in upstate New York, in one of the poorest counties in New York State. And so once we wound up on Wall Street, we started traveling around and worked for the 1% of 1%. We would go in and work with financial advisors to help them devise the best plan, the best portfolio construction for families that may have $100 million.
Yeah.
And so we looked at each other, my brother and I, that is, and said, man, I don't know that this is the people that really need the financial guidance and advice.
If you have a family office, you're going to be okay. If you have a family office, you're good.
Right. They're going to be just fine. And what we also realized is that, admittedly, although we were customizing these portfolios for these really rich folks and family to family, they were a little different. At the end of the day, investing needs on the broad stroke standpoint are very, very similar. And so we said, we believe there is dysfunction in Wall Street, and the dysfunction that we feel Wall Street was presenting is the fact that we just don't know that they make products that the average person understands, the layman understands. If you don't have an educational background on finance, really, it's a foreign language. And so when you look at, you go to iShares website or Vanguard's website or whatever it is, and I'm not picking on them, but there are 300, 400, 500 different mutual funds and ETFs.
Yeah, it's crazy.
All of them with names that are like, I don't know what this means.
Yeah.
And so at the end of the day, and we always use this hypothetical or this analysis, like when you buy a car, Michael, whether you're a mechanic or not, they don't send you all the parts individually and say, go ahead, you put it together.
No. Yeah.
Right? But that's exactly what's happening from a Wall Street perspective. All of these firms put together all the individual pieces and they say, good luck. And we talked, a few episodes back about the average investor's returns. Yeah. Some of this is all predicated on that. So at the end of the day, we broke away and we said, let's just make it easier on people. And so there are 10,000 mutual funds and ETFs for people to choose from. 96.7% of those mutual funds and ETFs are 100% equities, stocks.
Oh, wow.
Or 100% bonds. And at the end of the day, there are very few investors that belong exclusively in one of those two camps. Yeah. And therefore, it's incumbent upon the investor to take those two camps and combine them in some way.
Now,
and that takes an education. Go ahead.
Why is that? That just seems stupid to me. Right. Again, I'm not on Wall Street. I'm not even a stock guy, right? Definitely a real estate guy. But that just seems foolish to be 100% stock. Again, 97% either all stock or all bonds. And then you leave it to the individual to go, oh, I'll take 70% of that, 30% of that. That's not, I didn't know that. That's not good.
Yeah. It's interesting. And the cynical view is the fact that they have so much in an asset base in those individual sleeves that they don't want to put something together and cannibalize money coming out of those individual pieces and going into this more. That's a cynical view, right? So, another take on it may be, candidly, I think that's probably what.
Yeah, of course it is. At the end of the day, it's a system that is motivated by money, so we don't need to sugarcoat it.
Right.
That's okay.
So let me tell you how it gets better, though.
Okay.
Yeah. So let me tell you how it gets better. So, Michael, let's say that you own, as an individual, hypothetically, stocks, bonds, commodities. You own those three asset classes all at a third. Again, just totally hypothetical.
Yep.
Over time, say, it's the first quarter and stocks get hammered and that shrinks and you want to reallocate back into stocks. Actually, let's do the other way. So that doesn't work well. So stocks run, they go up and you want to sell out of stocks and rebalance back into bonds.
Right.
When you sell out of something that's at a gain and put it back into rebalancing back, what do you have to pay?
Taxes.
You have to pay taxes, right? So what's the coolest thing about a product called a multi-asset ETF, which is what we run at Life Goal Investments? A multi-asset ETF, the portfolio manager can put inside of the portfolio stocks, bonds, commodities, real estate, gold, whatever it is. And when we rebalance the portfolio on your behalf, there is no capital gain that gets distributed to the end user. Now, this is unique to ETFs. If it was a mutual fund, there is a capital gain that gets distributed out to the end user. The ETF is a wrapper that is a tax harbinger. It keeps the tax inside and does not distribute it out to the individual user.
So I just want to repeat what I heard as a layman. So you have an ETF. I believe the symbol was HOM, right?
Yep, that's one of them. Exactly right.
One of them. So inside that, you decide that for whatever reason, I'm just going to do averages again, a third, right? We talked about earlier. Something runs. Now it's, it's 40, 30, or I don't know, whatever. It just one runs and the others don't. You want to take some gains off the top and give it to the other. So you stay balanced once a quarter, once a year, whenever it is. What you're saying is because it's in the ETF wrapper, you can do that tax efficiently. And I, as the owner of HOM, never see it, never pay taxes, none of that stuff.
That's correct. That's absolutely correct. Whereas if you bought them all individually and sold them throughout, you would pay the capital gains that's associated with that.
Yeah. And then, in the, what the Wall Street would tell you is go ahead and do some tax loss harvesting. Right.
Right.
That's
right.
Oh, sell your winners, sell some losers, and you're even. Well, that's not what I'm trying to do here.
I want all winners.
Yeah. Why am I trying? I mean, that's what always drives me crazy. So why am I making decisions solely based on taxes? It drives me crazy.
No. Yeah. So again, and I'll reiterate one thing, because I think that everyone looks at ETFs and mutual funds as kind of synonymous with each other. And this is the really point of maximum differentiation of, and is the fact that the ETF, and I'll show you evidence of this in a second, the ETF is a more tax efficient vehicle. If you were doing the same thing inside of the mutual fund, it gets distributed out at the end of the year to the shareholders. And the evidence of an ETF being a superior vehicle to a mutual fund, and you could say I'm biased because we run ETFs, but the numbers are the numbers. Every single year, ETFs take in assets net, and mutual funds bleed assets net.
Yeah.
And that is for that very reason. Now, more people are going to be familiar with mutual funds because there's $27 trillion in mutual funds and there's 7 to 8 trillion in ETFs. But it's a tide that's shifting very slowly that will continue to shift very slowly.
Oh, there's no question. I mean, you just look at the returns X taxes and ETFs has a better, it's just simple math, right? You're not paying 8 or 9 points in taxes.
Correct.
And again, Kathy Wood, probably the best known name in ETF land, right? She has ARK, I think it is.
ARKK. Yep.
ARK. And it is an ETF. I think a lot of people think Kathy Wood and think mutual fund. It's an ETF, unless I misunderstood.
Nope. You're 100% correct. That is an ETF. And with an actively managed portfolio where you're going to be buying and selling underlying stocks, in her case, it's absolutely the right vehicle to be housed in. And what you'll see, Michael, and you're already seeing this, is that there is a dearth, almost zero, new mutual funds being launched.
Absolutely. ETFs are the way to go.
Consistently more ETFs being launched. And in fact, so like some of the firms that I used to work at, what they do is you're not allowed to launch the exact same ETF as you have existing mutual fund.
Of course.
So say you have So say you have a large cap growth, right? Yep. So what they do is they say, we're going to put large cap growth ESG on this, or small cap ESG, whatever it might be. And the reason they do that is because there's a de minimis amount of difference between them, called a few underlying holdings, but it's not the same strategy then. And therefore they skirt that rule and they've launched a second product in ETF format.
Yeah. It wouldn't shock me again. I don't have any skin in the game. I'm not a player in either mutual funds or ETFs. I suspect ETFs will dwarf mutual funds in a decade. It's just the tide's turned. It's a more efficient mechanism. You're returning more to the shareholder.
And the other thing that we didn't mention on it that I think most people actually are aware of is that ETFs trade throughout the day. So
that's true.
And not that, I think most of them aren't really, like our products certainly aren't meant to be bought and sold within a day. But that being said, the access to capital is much more prevalent in an ETF than a mutual fund that trades only once a day. So you can buy it and sell it. Say there's, massive dislocation in the market in the middle of the day, and you're someone who likes to pay attention and wants to buy when the market's down 5%. If it was, that's an extreme example. You could place that trade in the ETF at that instant, whereas you couldn't with a mutual fund.
Well, Dow transfers were down 5% on Friday. That caught some people's attention.
Yeah, exactly right. And at the end of the day, like I'm certainly talking out of both sides of my mouth a little bit here, because what I said to begin with, and the reason the launch of Life Goal Investments took place, is the fact that we think that the layman, the retail investor that wants an easier solution, is being underserved.
Yeah.
And then it goes back to the fact that if they have a professional that they understand what they're doing at the end of the day, and we make it very clear. So on our website, we have 3 ETFs: Home, HOM, which you just made mention of, Wealth Builder, WLTH, and then Conservative Wealth Builder, which the ticker is SAVN. Each one of those on our website has a 1 minute long video, no longer, that tells you exactly what that product is meant to do and how it is intended to be used. And so what we're trying to do there is build comfort in people's understanding of how it's managed, how it should react in certain markets, to make them more comfortable. Because again, when the tough times happen, it's really hard to stay comfortable. But if you're involving a portfolio that has stocks, bonds, etc., all mixed together to kind of make it less volatile, and someone's telling you exactly why they're doing what they're doing, that's an easier game than you going out and not really knowing all that well what you're buying and why you're buying it. Because when the rubber meets the road, then you go, I have no idea when I'm doing the right thing. I'm getting out.
Yeah.
And that's at the bottom.
Well, you know what we're going to do next Monday? I want to leave this here so you can prepare. I'm sure you have it, but you'll be prepared for next week. We'll do 3 videos next week, 1 on each of those. So if you have PowerPoint or however you feel comfortable talking about it, I want to know what's inside each of those 3. So that will be our 3 topics next Monday. What do you think?
Love that. Love the opportunity to talk about them. Thank you.
Awesome. And then what is your Instagram page? Because everybody needs to follow you. I am now following you myself.
You're the man. At Life Goal Investments.
Awesome, buddy. Thank you very much.
Thanks, Michael.